Today's topic is mastering accounting and taxation of shares, futures, and options. The resource persons are CA Wasim Beg and Shubham and Rati, both of whom are experts in their respective fields. Let us start by introducing CA Wasim Beg, who is a chartered accountant and has a vast experience in teaching in Mumbai and Aurangabad. He has a proficiency in teaching subjects like costing, FM, taxation, and accounts, and is also academic director at School of Finance, which is an NGO with an initiative to bring students to CA profession and helping them to clear CA. He has also been mentoring and tutoring a number of CA, CS, and CMA students. He has also a vast training experience and has given a number of seminars on understanding taxation and tax planning at various organizations. He is also a teacher for various subjects at schools of finance. With this brief introduction, I request CA Wasim Beg to take over and present his paper. Thank you, sir.
Yeah, thank you, sir. Good evening, everyone. Am I audible?
Yes, sir.
Yes, sir. Good evening. First of all, thanks for the opportunity given to us, and heartily congratulations to your branch on securing second prize. Hope all you are fit and fine and taking good care of yourself and family. COVID-19 is a big setback for many, but market got a lot of new investors, a new opportunity for us. Some may call it headache. Let's leave it to individuals. Now, in last couple of years, so many people started trading. So a lot of calculations, tax planning, and return filing with their share trading become a very tedious activity. In numbers, average 13 lakh new demat accounts are added every month from April 2020 to May 2021. That means roughly around 6.9 crores of new demat accounts. So a big opportunity for us. Here, share. So here we'll discuss here the accounting of shares as investment, accounting of shares as business, accounting of intraday trading, the accounting of futures and options, and their presentation in financial statements. Let's start with accounting of shares as investment. For this, we need some ledgers to be created. This ledgers are share purchase account, investment, and shares sales account. This both accounts should be made in the investment group. Then in this both ledgers, when we create, the inventory value should be yes. Stock broker account can be created in creditors or debtors. But by nature, it should be preferably creditor. So, but every time it has a debit balance with it. So advances with creditors can be treated. It can be treated like that. Then the STT, capital account. STT should be created in capital account. There are some more accounts like brokerage and other charges. In investment, both these accounts cannot be should be capitalized to the individual script, and another two accounts are required there, that is long-term capital gain and short-term capital gain. These both accounts will be created in capital accounts. Brokerage and other charges, they are allowed as an expenses, but STT is not allowed in case of investments. In rather, when we'll see invest account shares as business, their STT is allowed as an expenditure, but in case of investment, when we take it as a capital gain, there it is not allowed as an expense. Let's see. And another thing, inventory valuation should be set as FIFO perpetual. Every time there is tally, in tally there is it is in on average basis. Yes, I have created a couple of examples for explaining this accounting entry. We'll just say these entries, these examples rather. I'm buying Videocon shares of 125 quantity at the rate of 100, and 2 rupees. 2 rupees is brokerage charges per unit. So the net rate is 102. The brokerage comes to around. Yeah. So the net rate is 102. The brokerage amount is 125. That is 125 quantity multiplied by 2. So 250 is the brokerage amount. GST on brokerage 45 rupees. This is 18%. Contract value is 125 multiplied by 100 plus 250 plus 45. That is around 12,795. And there is STT. Say it is of 50 rupees. There is stamp duty on it, 5 rupees. So the complete amount is 12,850. And similarly, two sale entries can be have taken into this account. First is for short term. I have taken on 15th of April to 2021. It is for 50 quantity. 125 is the rate, and rest is this one. And similarly, on 25th May 2022, that is after 12 months have elapsed, this Videocon shares have been sold at the remaining shares, that is 75 shares, have been sold at 135. Same brokerage, and similar will be the example. I'll share this sheets later on so that you can have this for your reference. And there is another example that is of this Lupine. Lupine shares have been purchased at 112 quantity have been purchased. I have taken this example for splitting of shares. The entry what will do for splitting. Okay. I already made certain accounts. So first we are taking shares as investor. Here, as I already told, there are two accounts: share purchase account and share sales account. Both the accounts are in investments. So we'll first see that share purchase account. We are taking this. For accounting, the price of security, we have taken this. That is price, the net value minus STT. Because STT, we are separating it from the value of shares. 12,800, 12,850 minus 50. So 12,800 is our shares. Videocon 125 numbers, and 12,800 we have taken it as this one. In STT, there is 50 rupees, and for Zerodha is our stockbroker account. So we have created this amount to it, 12,850. Okay. In narration, we generally put the contract note number for the references. Another purchase entry. This is for Lupine. We have taken this similar entry. first we'll complete that video con entries. Then there is sale entry. In sales, you can take this Zerodha stockbroker account 6018, how it is taken as 6018. This amount will be debited to Zerodha amount and 50 rupees for STT, and the actual price is 6068. STT is 50 rupees and share sales account is created with 6068. This 948 rupees comes as the short-term capital gain. How it comes, I'll show you. Stock summary. Just a minute. Yeah, this video con. We have taken this 125 rupees, this shares, buyed it, and on 15th of April, we have sold it. So in Excel, if we'll do the calculation part, 12,800 is the cost. That is around 102 is the rate. So for 50 sales, it is 5120. Now the actual profit, the profit is 948. We can have this in here also. Just and another sale is made on 25th of May, that is after 12 months. And this entry is for remaining 75 shares. We have taken this as the 135 rate. So how it comes? It comes at on contract note, we'll get 9804, but we have to deduct the STT amount. So STT is added back to it. So 9854 is the total amount, and the STT is of 50 rupees. Similarly, this entry has been made, and the profitability, we can have this like this: 75 shares for 102.4, and the actual profit, actual gain is 2174.5. Can have this here also. What happened? Yeah. So here the profit, it shows 948 as gross profit. Similarly, here 2174 as the gross profit. We can make the entries in the investment, that is sales account. We have to make the short-term capital gain is created, and share sales account can be debited 948 rupees. And similarly, LTCG, long-term capital gain, can be made on 25th of May, the day on which we have sold the shares, 2174. And similarly, 2174 is created to the long-term capital gain. And another entry, that Lupine entry, this. On 12th July, we have bought this share. Yes, on 12th July, we have bought this share, 112 quantity at the rate of 60. Similarly, all the calculations are there. Here, again, we have to deduct the STT. So we can deduct it from the net value. 6791 is the basic actual cost, actual price of security. and the 35 rupees is STT. Same is the entry we can make. Share purchase account is debited Lupine 112 shares at the rate of 60.63, 6791.08, and STT 35 rupees, and zero the account is created with 6826. The contract note number is put in that narration. On 15th of March, the split takes place. So the 15th of March, we have to make the entry. We have to debit the purchase account, Lupine 224 shares, the split account. That means I have taken this example as 1:2 split. So here the 112 quantity is splitted into 2. That means 224 new shares have been brought. So 224 number, don't put the rates, just put the same amount, 6791, what at the rate, at what rate we have purchased it, 6791.08, and credit it with the share purchase account, and 112 is put in the inventory amount, and 6791.08. So when we'll see the stock summary, we'll find it 112 shares have been purchased. Now the 224 number, this amount has been came out. Here the amount comes at different because of the actual pricing of the, sorry, in tally there is always average pricing has been maintained in the inventory. So we can change this inventory valuation to FIFO method, and we'll get the same amount, that is 6791. Now let's see accounting entries of share transaction, and also share transaction as a traders. We'll see these entries also. Same examples have been taken. This share traders account, same entries. Just I have made these 2 entries in a single year, so that complete all the shares can be exhausted in the same year. Here 125 quantity at the rate same, everything is same. Here some different things come here. That is STT is allowed as an expense in this case. As a trader, when we are trading, we can claim this STT as an expense. Similarly, brokerage and other expenses can also be claimed as an expenses. So we are bifurcating it here. In case of investors, we have added these 2 expenses, stamp duty and brokerage, into the actual price of security. But here we are separating it, bifurcating it from it. So the actual price of security is 125 multiplied by 100, that is 12,500. The brokerage is 250. STT amount is 50, and other expenses is 45 as GST, and stamp duty 5 rupees. All these amounts can be taken as. Now Appendo, share as trader. Here the same ledgers have been required, but the group is changed. Share purchase account, share sales account. So here the share purchase account goes into the purchase group. Share sales account goes in the sales group, with both the inventory value as yes. Stock broker account, creator or dater, preferably creator. Here this STT is direct expenses, brokerage is direct expenses, and other charges are direct expenses. All expenses are allowed in this case. Tally entry spreadsheet. So we'll see here the profit and loss account. Here we make share sales account. These entries we have made it. Purchase account, we have share purchase account. Direct expenses, there is brokerage, other charges, say STT, all these are in the direct expenses. So first we'll make this entry, 12,500. Similarly. Here. Videocon shares have been purchased at 125 quantity have been purchased at the rate of 100. So 125, 12,500 is the amount. Here the brokerage is 250, STT is 50, other charges are 50. So the complete amount comes to 12,850. These are relatively simpler than what we have seen in the share as a share investor. Here on the 12th of July, we have bought another share of Lupin. Similar is the case here. 112 multiplied by 60, brokerage, STT, and stamp duty. All this amount have been taken, brokerage, STT, other charges, and the contract note number. We'll see later the split. Split is same. On 15th of March, Lupin shares 224, that 30 rupees at the rate of 30 rupees. What is this? 672, 224 shares. Don't put this amount, just put 6720. So 30 rupees is auto calculated. And credit is same Lupin shares, 112 shares, 6720. Here it is 60 rupees per share. This is split. Now we'll have a sales account. The both this Videocon shares have been sold. On 15th of April, we are doing this zero the stockbroker account have been debited with 6018, this amount. 6018, this amount have been debited. Brokerage is 150, STT is 50, other charges is 32, and actual price of shares which have been sold is 6250. So 6250, this have been sold. Other expenses have been deducted from it, and we'll get the profit accordingly. On 25th of May, similar entry, zero the account 9804. Brokerage, STT, other charges have been debited, and the credit amount is taken here as 10,125. All this have been taken. Here the gross profit comes to around 5190. It should be. Inventory variation. Okay. There is another thing, that is intraday trading. Intraday trading, it is a speculative transactions, and capital gain. It is not capital gain. Actually, it is speculative business transactions. And intraday trades of derivative instruments, it is business income and not speculative. But intraday trades of shares, it is capital gain, speculative transactions. Okay. we can see the accounting of intraday trades. It is rather very simple. We have to create this single account. This is intraday profit and intraday loss. We have to put both the entries in this intraday profit and loss account. On first, we have it is loss of 625 rupees, and later on the second transaction it is profit. So the net profit is 341. But in this case, the turnover is the addition of these two, that is 625 plus 966. This is the turnover 1591. We have to add the absolute values of the profit and losses. Then the whatever value comes, it is the actual turnover in this case. We need just two ledgers, intraday profit and loss account and the broker account. Here it is this broker account. In the first case, it is loss. On second, it is profit. Okay. Let's move to futures and options. Before moving to the futures and options, the accounting part of the futures and options, we'll have some question answers, as it is very confusing at times. Like Appendo transaction is business income or capital gain income. In my view, it is business income, PGBP. But there are some what will say answers to it, that they say it is also can be treated as capital gain. Like साल भर में एक दो एंट्री किया है हमने सिर्फ, तो हम उसको कैपिटल गेन क्यों ना ट्रीट करें? You can treat it, but on most as per accounting standards given by the institute, it should be treated as business income, PGBP. And there is another question, whether F&O transactions are speculative transactions. The answer is yes. By nature, it is a speculative transaction because there is no actual delivery happening here. But as per the definition 43.5, definition of speculative transaction, it is specifically given the exception for Appendo. So it's not speculative transaction because there is an exception in the definition. Else, it should be treated as speculative by nature. Losses from Appendo can be set off against other businesses. Yes, for sure. As Appendo is covered under PGBP, except salary, you can set off the losses with other businesses. The next answer. Losses from Appendo can be set off against other heads of income. Yes. Except with salary, Appendo losses can be set off against house property, capital gain, income from other sources, and so on. What's the tax audit limit for Appendo? Answer is 1 crore, 2 crore, 10 crores. How much it should be? Since usually it is 100% transactions are other than cash, it may be covered under 10 crore limit. So we can have this 10 crore limit for Appendo transaction because there is no cash transaction, not even a single cash transaction happens here. Whether special rate of Appendo transactions, is there any special tax rate for Appendo transactions? No special rates. If individual or HUF, there is normal slab rate. In case of firms, it is 30%. If it is company who is dealing in the Appendo, it is 22%, 25 or 30% as the case may be. Whether 44AD can be applied for income from Appendo transactions, since all transactions are accounted and P&L is given by the broker. So this is what I think, that in this case we have all the accounting and we have all the transaction accounted in it. So we can't apply this 44AD, but there are some opinions that 44AD can be applied. It depends on individual. Books of accounts and documents for Appendo required to be maintained. What are the books of accounts? Whether books of accounts are required? Yes, accounts maintained by broker along with bank statement are enough. Whether other expenses against Appendo income? Yes, related expenses only. Whether other expenses against Appendo income is allowed? Yes, surely. Related expenses only, that is interest income if the loan is taken for investment, for doing the investment in Appendo. Brokerage if paid any salary, if assessee employed someone to do this transactions. What are the audit points while doing this? We have to match the account and documents provided by brokers. Take following documents from we have to take certain documents from the broker. That is annual transaction statement, that is trading account, contract notes, P&L statement, capital gain statement, transaction statement script wise mentioning buy and sale rate, detail and summary, open positions at the end of the year, STT and other taxes statement. We have to take all these documents from the broker. We have to check the balances at the end of the balance of the broker and the open positions of the entries. Whether TDS applicable, we have to see the TDS applicability. On brokerage, we have to apply in 194C. On interest, if broker charges the assessee any deposit any interest on deposit amount, then on that interest we have to deduct TDS under section 194A. If the portfolio management services have been taken and any other professional fees have been charged, then on that amount we have to deduct the TDS under section 194J. We have to test check the contract notes and emails from NSE, PSE with data given by the brokers, because in recent past there are some malpractices happened. So it is our duty to just at least test check the contract notes. Open positions at the end of the year shall be separately disclosed. It should be disclosed separately. This one question, tax audit limit for Appendo. We have given special rates. We have taken all this. The accounting perspective. Now let's see the accounting entries of Appendo. It is very simple. Here we require the ledgers, future sales account in the sales group, and future purchase account in your purchase group. This is the contract note for the buy value of the shares. Say Tata shares have been purchased 100 shares at the rate of 12 rupees per shares. This is the margin we have to give. So only the margin amount is entered here. Future purchase account 1200 and 1200 rupees have been created to zero the account. And similarly, when we have the sales, then there is the margin amount of Tata 150 rupees have been taken, 150 numbers at the rate of 15,2250. These two amounts have been taken here. So here also all the expenses related to Appendo transactions can be claimed as are allowed as an expenses, because it is it is treated as just PGP. Okay, so that's it from me. Now, so can I hand it over to? Hello, can I hand it over
Yes,
to
sir.
Shubham, sir? Yeah.
Yeah.
Hello. Yes, sir.
Just 1 minute, sir. I'm trying
Yes,
to
sir. Yes, sir.
connect.
Okay, fine.
I welcome CA Shubham Rathi. CA Shubham Rathi is a chartered accountant and an advocate and has been practicing in income tax litigation along with representations before the Commissioner of Appeals and drafting of writ petitions and briefing counsels before High Court. He has also been involved in giving opinions on income tax issues, corporate law, and other allied provisions. He has been giving advice on capital tax planning, various tax issues, and has been a frequent lecturer on various topics of income tax. And he's also done a lot of legal research on various provisions of income tax and other laws, and has been a researcher for the book Analysis of Direct Tax, Vivad Se Vishwas Act 2020, along with authoring various articles on income tax and Benami law. With this brief introduction, I request CA Shubham Rathi to take over for his treatise on mastering taxation of shares, futures, and options. Over to you, sir.
Am I audible?
Yes, sir.
Okay. So thank you for the introduction. I hope everyone has enjoyed the mastering accounting of shares, futures, and options. So now we'll move on to the taxation part of the similar, that is share, futures, and options. Now this part has become, this topic has become so important, because if we have the 10 income tax returns in our office as a chartered accountant or as a professional, out of 10 nowadays we will find that 6 to 7 assessees will be trading in the, either they will be trading or they'll be investing in the share market. This ratio was very less in prior to the COVID period. So if we as a chartered accountant, it is very important for us to know exactly the point of taxation and what type of taxation is done and when, in at what point of time. So the increase, and as the my co-speaker Wasim Beg sir has given us the statistics, how the ratio of number of demat accounts opening has been increased a lot. That can also be seen from the profit or the revenue that is earned by the our CDSL, the company which is listed on stock exchange, CDSL. It has shown a very huge growth in its revenue as well as profit. That itself shows that not only the accounts are open, but those accounts are operating and are actively, the traders of those accounts are actively trading in the share market. So directly now coming to the topic. So basically, we from the income tax perspective, we have 5 types of income to earn from the share market. That is short-term capital gain, long-term capital gain, intraday trading, futures and options trading, and dividend. So first of all, there are 3 types. There is cash market also, and there is Appendo market also. Then there are other incomes like dividend also in the share market. So we'll go one by one. So first of all, we will deal with the cash market. So what exactly is the cash market I'm talking about? So there are two types of equities in the market to trade for. One is the listed equity and another one is unlisted. So what are the listed equity? Listed equity are the equities of the listed company, whose the companies which are listed on the recognized stock exchange. And unlisted companies are the companies which are not listed. Those are public companies or maybe a private limited company. So basically, there are two types of transactions in the listed equity shares. One is delivery-based transaction and another is intraday transaction. So we'll go one by one and then we'll move on to unlisted. So first of all, we will see what is the delivery-based listed transaction. So delivery-based transactions is nothing but if we buy a particular share of a company, after receiving the delivery of that share, if we sell out that share, then it can be called as a delivery based transaction. Whereas in an intraday transaction, what we do is I purchase the share and in the same day I sell it back. So I square off my position in the same day, then it is called as intraday. If I receive the delivery, it is called as a delivery based transactions. So a question has been raised. I have seen in a chat box that one question has been raised: how to define the person, whether he is a trader or investor? This was a very good question, and I say it was very litigative question earlier. If I go to the brief history, in 2006 or 7, the CBDT had come up with a circular for the similar type of question. The CBDT, the board that time had said that if assessee, if an assessee, how the question was raised, how the person, the income should be offered, when to show the income from shares as a business income and when it should be shown as a capital gains. So that time the board has given solution that the intention of the assessee should be seen from the transaction. The assessing officer had given a liberty to decide the intention, whether the assessee was intended to do a business through the share transactions or he was investing in the share market with the aim to earn as a capital as an investment. So that due to the circular, huge litigation was cropped up because the assessing officer always used to if an assessee has offered the capital gains as an income, the assessing officer always used to prove that the intention of the assessee was not as an investment, but it was the intention. It was having an intention to do trading in the share market. So the ultimately the litigation has arose very huge. So to reduce the litigation, the board had come up with the new circular in 2016, circular number 6 of 2016, wherein they have clarified that irrespective of the period of holding, if the assessee wants to treat the stock shares as a stock in trade, in that case, the assessing officer shall not litigate the same and shall allow it as a business income without any dispute. In case of a shares held for more than period more than 12 months, in that case, the circular had the solution that if the assessee wants to treat it as a capital gain, but the assessee will have the binding that whatever the method he wants to follow, either capital gain or business income, it should be consistently followed. It cannot be done that in 1 year what I will do is I will offer the share income as a stock in trade. In another year I will offer it as a capital gain. No, it is not allowed. As per the board circular, whatever the treatment I am giving to the share transaction, it should be consistent every year. And in any other case, the earlier circular will be applicable. So my suggestion to the our professionals is that if their assessee or if their clients are doing actively trading in the share market, they can suggest their clients that they should maintain two demat accounts. One is for a trading purpose and another one for investing. If they're having investment for a long term, then a particular account should be maintained for such investments. And if they are trading in some shares, intraday tradings, or if the number of transactions in the demat account is very frequent, in that case there is a huge chance that the assessing officer will treat the income from such a transaction as a business income. So if frequent trading is to be done, that should be done from separate account. And if investment is to be done, that should be done from a separate account. So in that case, if a notice comes or if a litigation crops up, it will be very easy to prove that they see this one account is particularly for business income, and this account is my investment. This account is only for investment purpose. I know it is very difficult to explain these things to client, but nowadays, as everything and every data is available with the income tax department, nothing is hidden from them. Even nowadays, the annual information system has come, new system has developed that everything if the assessee is doing any transaction, that is clearly reflected in the AIS, so nothing is hidden from the income tax department. So it is very much, I mean, I can say it is very good advice to give to your clients that maintain two separate accounts. So basically, we have seen now we know that when to treat it as a business income, and now when to treat it as a capital gains. Now the question that we'll see what features the business income contains and what features the capital gain contains. So first of all, we'll start with the business income. So we all know the chargeability of business income is section 28. So always, if a delivery-based transaction is done, the income from such a delivery-based transaction is a non-speculative business income. Then deduction, all the types of expenses as we claim in the regular business is allowed in case of share trading business also. This thing is to be noted that STT paid generally is not allowed, but in case of a business income, STT paid is also allowed under section 36(1)(15). So set off of losses is allowed. Non-speculative loss can be set off against any head except salary. Chapter 6A deduction is available, and tax rate is as per slab. Because the business income from delivery-based transaction is treated as normal, any other normal business income, there is nothing special given, no special provision is given in the income tax act for the same. Now coming to the capital gains, as we all know that capital gains are of two types: short-term capital gain and long-term capital gains. If the shares are held for 12 months or less than that, in that case, short-term capital gain will be, any capital gain arising from such shares will be treated as a short-term capital gain, and in any other case, it will be treated as a long-term capital gain. Deductions, only the expenses. In general, we claim expenses related to transfer of a capital asset for a computing capital gain. Similarly, here also we can claim only expenses related to transfer. No other expenses like any other expenses, even if incurred for trading or like investing in shares, we cannot claim it as an expenses. So generally, brokerages are allowed as an expenses. STT paid not allowed. Set off of losses. Short-term capital gain can be set off against both long-term and short-term capital gain, and long-term capital loss cannot be set off against long-term capital gain. Again, chapter 6A not available. Tax rate, in case of a long-term capital gain up to 1 lakh, it is exempt. Above 1 lakh, it is chargeable to tax at the 10%. So now, for an example, if I have a 4 lakh capital gain, long-term capital gain, so my first 1 lakh rupees will be exempt. So on balance 3 lakh, I will have to pay tax at the rate 10%. In case of short-term capital gain, section 111A is applicable, and here I have to pay flat 15% tax rate. There is no exemption and there is no slab to it, or it will be taxed at the rate flat 15%. Now we have seen this how the delivery-based transactions are generally taxed. Now coming to next aspect, that is taxability in case of bonus shares. So as we all know, many a times companies issue bonus shares to their shareholders. So the question arises, how to decide the taxability of such bonus shares. So it is very simple. First of all, the period of holding shall be from the date of issue of bonus shares. So date of issue of bonus shares will be the starting period of the period for the which we have held the shares, and it shall be computed till the date of sale of such a shares. So cost of acquisition is nil because I have not paid anything, and we don't have to pay anything for acquiring bonus shares. So cost of acquisition will be nil. Taxability, it will be the question now arises is when it will be taxed as a capital gain and when it will be taxed as a PGBP. So simple as we have seen earlier, if the original shares through which I have received the bonus shares is held as an stock in trade, in that case, it will be taxed as a business income. And if I am holding original shares as an this investment as an investment or an asset, so in that case, it will be taxed as a capital gains. So taxability of this case of right, now we'll come to the next aspect is the right issue or renunciation. So what is the right issue? Right issue is nothing but if a company wants to come up with the fresh issue of an shares, in that case, what they will do is they have an option to give first preference to their existing shareholders that if I'm a holding shares of Reliance, so if Reliance want to come up with the right issue, what Reliance may do is they will give preference to their existing shareholders by giving a right issue. So in what is the benefit for me as a right issue as a shareholder? So as a shareholder, in case of right issue, if a Reliance is trading at 2,000 rupees per share rate, so Reliance, what Reliance will do, they will give an offer to their existing shareholder. Instead of 2,000, you pay us 1,800. We will give 1,800 per share. We will give you the shares. So in that case, what the assessee or a shareholder will have the option of 15 a time of 15 days to execute his right or renounce his right. So if he's we will see the taxability if he has executed his right to purchase the share, and again we will see also we will see the taxation aspect in case of he renounced the shares. So what is renounce? Renunciation is nothing but when the assessee has either option to agree or accept the offer of company to accept the right issue, or either he has option to renounce his right. Renounce is what is renunciation is nothing but if I can give this offer to some other person who is not a shareholder of Reliance, and let's say for an example, I have got an offer of 1,800 per share from Reliance. What I will do, I'll give this offer to someone else. I will renounce this offer to someone else, and I will say, see, I have a right to purchase the Reliance share for 1,800. You pay me 50 rupees. I will give this right to you. So this is the renunciation, that selling out that right to someone else. This is what the renunciation is called. So we will see the taxation aspect in case of renunciation also. First, we will see the taxation aspect if the shareholder accepts the offer of the company. So period of holding shall be computed from the date of allotment of shares. The period of holding will start from the date of allotment of shares, and it will be computed till the date these shares are sold. So cost of acquisition, as I said in our example, will be 1,800. Even if the market value or the listing price of that share in the current market price in the recognized stock exchange is 2,000, but what I'm incurring, what the actual cost I'm incurring will be the cost of acquisition. So a cost of acquisition shall include the cost paid to the company for acquiring the shares and cost paid to the renouncer for acquiring the right. So computation of capital gain will be the full value of consideration less cost of acquisition. Now coming to in case taxability in case of this renunciation. What if I renounce the right? So in that case, it will be let's say for an example, if I renounce the right, so it will always be a short-term capital gain, and the 50 rupees will be charged to tax as a my income, and it will depend if the original shares as held as an investment, it will be taxed as a capital gain, and if original shares as held as a stock in trade, then it will be treated or it will be taxed as a business income. So now coming to the taxability in case of right issue or renunciation. So what if I renounce these shares? So in that case, what will be the taxability in the hands of renouncee? Renouncee means the person who has the person who I have sold my right and he has purchased that right from me. For an example, I have sold that right to Mr. Ramesh, and Ramesh has given me 50 rupees for accepting or taking that right from me. So the cost of acquisition for Ramesh, the 1800 paid to the company plus 50 rupees paid to me. So the cost of acquisition in his case will be 1850, that is 1850. And as I have already said, the period of holding shall start from the date of allotment and it will be computed to the date of sale. So again, computation of capital gain is normal computation, full value of consideration less cost of acquisition. Again, if any transfer related expenses are incurred, that will be allowed as a deduction. Now coming to again next aspect, that is taxability of ESOP. So we all know that equity ESOP are many times blue chip companies give ESOP to their employees. It is very common practice to give ESOPs to their employees. So at the we will see how the ESOPs are taxed in the hands of employee. So basically, when what is the concept of ESOP? ESOP is issued to the employees. I mean, the shares are issued to the employees at a discounted rate. As we have seen in the right issue, similar concept is ESOP. ESOP is only for the employees. So here, if the market value of Reliance is 2000, ESOPs will be issued to their employees, and employees will be given an offer to purchase the shares of 2000 for 1800 only. So basically, they will have the discount of 200 rupees in their hand to purchase the shares of Reliance. So, so whether this 200 rupees discount given to the employees is exempt or whether it will be taxed in the hands of employees. So my answer to this is yes. The difference of 200 rupees will be taxed as will be treated as a perquisite in the hands of assessee or I can say an employee. So the employee will have to pay tax on 200 rupees as a and it will be taxed as a salary income. So period of holding shall be computed from the date of allotment of shares, and computation of capital gain shall be sale consideration less FME. Now this is the benefit because I have already paid 200 rupees tax on the additional discount I have received. So 1800 will not be cost of acquisition to me. The cost of acquisition will be the FMV on the date of allotment. So how to compute this FMV on? So I have prepared a chart here. So this chart, if you see the chart, there are two types of shares: listed shares and unlisted shares. If the listed company gives ESOPs to their employees, then the competition will be if the stock is traded on the recognized stock exchange on the exercise date. Let's say, for an example, allotment on the allotment date, if it is holiday on the in the stock exchange, in that case, we have to see the closing price of earlier day. Let's say, for an example, a particular day when there is an holiday to a stock exchange. On that day, if the shares are allotted to the employee, in that case, the closing price of a prior day shall be taken as a FMB. And in case if the shares are traded on that day, in that case, if the company is listed on both the stock exchange, let's say BSE and NSE, so we have to see on which stock exchange on that day, on particular that day, on which stock exchange the highest volume was there. Because if the NSE has the highest volume for that stock, then in that case the average opening and closing price of that stock will be taken as a FMB. In case of BSE had the highest volume for that stock, in that case average of opening and closing price of BSE will be taken as a FMB. And in case of unlisted shares, the price FMV price shall be determined, or the certificate for FMV shall be obtained from the merchant banker. So I think it is clear to all of you how to compute the FMV in case of ESOPs. Moving on to the next aspect. So we have completed here the delivery based. Then we have seen the taxation of bonus shares. Then we had moved on to the right issue. Then we have also seen the ESOPs. Now we have completed all the delivery based transactions. Now coming to the next aspect, that is intraday trading of a listed shares. So as my co-speaker had already explained what is the intraday trading, at the cost of repetition, I will just again explain in few words what is the intraday trading. Intraday trading is nothing but the squaring of your position on the same day on which you have bought those shares. So basic difference between the intraday trading and delivery based transactions. In intraday trading, you play with the price of the shares in the during the day, and in delivery based transactions, there may be motive to play with the motive of investing in the shares. So now we will see the taxation part of intraday trading. Definition 43.5 is given in the Income Tax Act, which specifically defines what is the speculative read for a moment, a transaction in which a contract of the purchase or sale of any commodity, including stocks and shares, is periodically or ultimately settled otherwise than by actual delivery or transfer of the commodity or scripts. So this definition clearly says that if the assessee is squaring up his position or is during the day only without taking a delivery, in that case, the transaction will be treated as a speculative transaction, and the income from such a transaction shall be taxed as a speculative business transactions. So there is no scope in this case of taxing it as a capital gains. It will be fully taxed as a business income only, and that too speculative business income. So coming to our next part of the intraday trading. So the profit or loss from intraday trading is treated as a speculative business income, as I have already stated this. All the expenses as normal business is required. All those expenses are also allowed as a deduction, but one has to keep in mind that expenses shall be related to the business. No personal expenses will be allowed in this. Tax will be charged as a normal tax slab. Losses can be set off only against speculative business income. This has to be kept in mind. Speculative income, the loss or income of the loss shall be only set off against the speculative income. It cannot be set off against any other head. And unobserved speculation business loss can be carried forward only up to 4 years. Generally, the losses are carried forward in for 8 years, but in case of a speculative business, it will be only carried forward for 4 years only. So the very basic question everyone asks is, what is the how to compute the turnover in case of a intraday trading? So I have given a tabular example here. So first of all, I'll explain the definition or how the turnover is to be computed. First of all, income tax has not given any definition or any way out to compute the turnover, but our institute has issued a guidance note for the same. And as per the guidance note of the institute, it says that the absolute total of the favorable and unfavorable differences shall be taken of those transactions. So I will explain it through an example. Let's say for an example, I had purchased a Reliance share of 1,000 units for a 2,000 at the rate of 2,000 per share, and I have sold those shares for 2,150. And if you see the difference, it is 150 rupees per share. So if I multiply the difference of 150 with the 1,000 units, so the difference will come to 1,50,000. So this difference is treated as the turnover of for computing the turnover in case of intraday trading. Again, coming to next example, I will take the example of bail. So if I take the example of bail, in case of bail, I have purchased 5,000 shares for 60 rupees and I have sold it for 63 rupees. Again, here the difference is of 3 rupees. If I multiply those 3 rupees with 5,000, so the difference is of rupees 15,000 rupees. So again, 15,000 in the case of bail is the 15,000 is the turnover for me. Coming to next example, Infosys. Here, if we see, it is very important to understand. Here, if we see this Infosys, I had purchased those shares of 500. I have purchased 500 shares for 1450, 1450, and I have sold it for a loss of. I have sold it for 1375. So here I had incurred a loss of 75 rupees per share. So if I multiply those 75 rupees with the 500, so I had a loss of 37,500. So you will clearly see in the column of difference that I have put minus 37,500 because it is a loss. But while computing turnover, it is very important to keep in mind that the difference should, in case of a computing turnover, negative sign has to be ignored. So for computing the difference, I have seen, see here I have taken the turnover of 1,50,000 in case of Reliance, in case of 15,000, and for Infosys I have 2,500. Even I have put the negative sign over here, but for computing the turnover, if we take the total, it is 2,02,500. I have ignored this negative sign and I have computed the turnover of 2,02,500. Similarly, we see the gross profit. So gross profit in all the in the case of Reliance and BHEL, the gross profit and turnover is similar. But in case of Infosys, the gross profit will be negative 37,500, but turnover will be the positive 37,500. This important thing has to be kept. Now the question arises how to compute the turnover, but the issue is how to show this intraday trading in the ITR. So it is I have reproduced the relevant schedule of ITR. This is the ITR 3. I mean, this is the format of ITR 3, and I have taken the screenshot of the relevant schedule. So if we this is the schedule P&L entry number 665. So here clearly they have mentioned turnover from speculative activity. So you have to mention the turnover. In our case, in this case, we had a turnover of 2,02,500. So turnover will be 2,02,500. Gross profit we had 1,27,500. So in this case, we can put gross profit as a 1,27,500. Expenditure only related to business can be I mean written in the column this 65.3, and the difference, I mean the automatically the system will calculate the net income from speculative activity. One should mention, because this is the question which I have been asked in every seminar or every lecture I have taken. So one should keep in mind that the entry number 65, where I have to mention details regarding the speculative business income. Coming to the, as we have finished our listed transactions, listed equity transaction, that is delivered in intraday. Now coming to next aspect, that is unlisted shares. So what is unlisted shares? I have explained it earlier. It is nothing but the shares of an unlisted company, which can be a public limited company or a private limited company. So in unlisted transaction, unlisted shares, there cannot be trading because those are not easily tradable. One has to, if one buys those shares, but will have to keep it as a investment and can every day. So there is no interest. So I have taken the example of delivery based transactions. So we will see what is the delivery based transaction unlisted shares. So basically, again, we have to see in case of the delivery based transactions, there are two types of share transactions: the long term capital assets and other one is short term capital asset. One has to keep in mind shares or long term is done on the basis of month. Those are 24 months. We have seen the listed, in case of listed shares, period holding, if the share is held for more than 12 months, it was treated as a long term capital asset. But in case of unlisted shares, if the shares are held for more than 24 months, only in that case the shares will be treated as a long-term capital asset. Otherwise, it will be treated as a short-term capital asset. This basic difference has to be kept in mind while computing the capital gain in case of unlisted shares and in case of unlisted shares and listed shares. Sorry. So computation of capital gain is again very simple. One has to compute share consideration. One has to see similar to the are listed computation of capital gain is of listed shares. So share consideration minus transfer expenses will arrive at the net consideration and the cost of acquisition. Or in this has to be kept in mind in case of unlisted shares and long term indexed cost of acquisition is indexation is allowed. The indexation is not allowed in case of listed share transaction and short term unlisted share transaction also. So indexation is allowed only in case of long term capital assets and only for unlisted shares. So the issue may arise is, जैसा हमने देखा है कि if it is not registered or it is not listed on stock exchange, how we will decide or we can sell it at whatever rate we want to sell. जैसे if there is a provision of 50C, 43C, CA that immovable property cannot be transferred at whatever rate the assessee wants. Minimum, the assessee has to pay tax on the minimum stamp duty value or actual consideration, whichever is higher. Whether a similar provision is there or not in case of unlisted shares. So I would say yes, there is a provision under section 50C. Like 50, we have 50C for immovable property. Provision 50 list. So cannot sell share at what no. Share the FMV. If the shares are at the price or consideration less than FMV, in that case, the minimum or a consideration which will be taken for computing capital gain will be the FMV. So, like 50C, there is a provision of 50CA for the transactions like unlisted shares. One has to keep this in mind. Not only if we sell the shares for less than FMV, that will not only affect the transferor or transferor, but it will also affect the transferee. So if I purchase the shares for less than FMV, then there is a provision under section 56(2)(10) wherein they have clearly stated that if the shares are purchased for less than FMV, then the difference, because that those shares will be purchased for inadequate consideration, and section 56(2)(10) clearly is applicable wherein the shares are purchased for inadequate consideration. So the difference in FMV and the consideration for which I have received will be taxed under section 56(2)(10) in case of unlisted shares. So one may ask a question that how to compute the FMV. So FMV can be computed as per the rule 11 UA given in the income tax rules. Coming to the taxability of unlisted shares, at what tax rate the unlisted shares shall be taxable. So the long-term capital gain shall be taxed at the rate of 20%. So the exemption of 1 lakh, which was I had already explained that the exemption of 1 lakh is given in case of long-term capital gain. So this is only applicable only to the listed shares. The exemption of 1 lakh is not applicable in case of unlisted shares. And short-term capital gain is taxed at the slab of the particular assessee. In case of the listed shares, I had explained that the tax rate of flat 15% is there, but in case of unlisted shares, the tax rate will be the slab of that particular assessee. So I have covered the aspect of this share transactions. So whatever the questions are there, that will take up at the end of this lecture. So directly we will move on to the taxation of Appendo, and this is the most important topic because many queries are raised regarding the futures and options only. So I had given the coverage in this slide what we are going to cover, or we will answers to these questions. This might happen that in my earlier session of few of the questions have already been answered by my co-speaker. I'll not repeat much, or I'll not go deep in that case, but I will give a brief introduction or brief answer to those questions. So my first basic question is whether income from Appendo transaction is business income or capital income. Many a times this question is asked whether Appendo transaction should be taxed as a business income or capital gain income. So as per section 43(5), if we see the definition of 43(5), then we will come to know that the Appendo also fits in the speculative business income of the definition given in the 43(5). But 43(5) specifically excludes these Appendo transactions from a speculative business. It clearly specifies that the Appendo transactions in equity will not be treated as a speculation business income. So it means that the business income from, income from the Appendo transaction shall be always business income, but it will be non-speculative business income. It will not be a speculative business, even if the nature is similar to the speculative income, but as it has been clearly excluded, it will be treated as a non-speculative business income. The next question is whether Appendo transaction is speculative transactions. So as already I have stated that even if the nature of the Appendo transaction is speculative, but it will be treated as a non-speculative transaction. Coming to next aspect, how to compute the turnover for tax audit purpose in respect of Appendo transactions. So as we have seen in the intraday trading, there is a separate method, innovative method to compute the turnover of intraday trading. Similarly is the case in case of Appendo also. So we will see different types of turnover in case of futures and in case of options. So the in case of futures, we have to compute the absolute. We have to take the absolute total of favorable and unfavorable differences. So here again, as we have ignored the negative sign in case of intraday trading, similarly in case of futures also we have to ignore the negative sign for computing the turnover in case of futures. What if I have done the transaction in options? How to compute the turnover? Similarly, in case of options also, we have to take the difference of absolute turnover, absolute difference in of the favorable and unfavorable, ignoring the negative sign. But here, additional, we have to add the premium received on sale of options while computing the turnover. So, in case of option, the first part of computing turnover will be the difference in the favorable and unfavorable plus the premium received on sale. This aspect will get more clear when we'll move on to the examples. And in case of reverse trades, what is the reverse trades? Generally, what people do is they short trade the transactions. Many a times, many shares are short. I mean, what do you mean by shorting the trade? Shorting the trades means first you sell those shares. The general practice is to buy the shares and then sell it. But in case of reverse trade, what the traders do is they sell these shares first. Then when the when the prices of the share decrease or in that case they buy those shares. This is called the reverse trade. In this case also you have to take the difference thereon. So moving on to the examples. So examples of computing turnover in case of futures. So first of all, I had bought the Nifty. So one lot of Nifty consists of 50 units. So I had bought Nifty at 15,000 rupees and sold it for 15,350. So here the difference is of 17,500 for 50 lots. I mean 50 units. Coming to SBI, I had purchased one lot of futures of SBI. The one lot consists of 1,500 units of SBI shares. So buying rate was 315. I had sold it for 420 rupees. Here again the difference is of 1,05,000. Next, Infosys, I had purchased one lot for 14,150 and I had sold it for the same rate 1,450. So here difference is 0. So here again for computing turnover, the different turnover will be 0. So in case of Coal India, I had purchased 4,200 units, that is one lot for 140 and I had sold it for 125. So I had sold it here for a loss. So there is a 15 rupees loss per unit. So 15 into 4,200 units, the loss comes to the 63,000. So if here I have written difference as a minus 63,000. But as I have already stated that you have to ignore the negative sign while computing the turnover. So the turnover here by taking the absolute total of the difference is 1,85,500. Coming to the next computation of turnover in case of options. So here I had purchased Nifty 15,000 call option. The unit, one lot consists of 50 units here also. So buying rate of that option was 120 rupees and I had sold it for 210 rupees. So here the difference is 4,500. If I take 120 minus 210, it comes to 90 rupees. So 90 into 50 units, it comes to 4,500. And premium received, how to compute premium received? So you see selling rate is 210 rupees per unit and I have a total 50 units over here. So if I multiply 210 my selling rate with the units I had purchased, it comes to 10,500. So while computing the turnover in case of option, I have to add the premium to my difference. So difference plus premium received on sale will be my turnover. So if you take the if you see or if you observe the computation of turnover in case of Nifty call options, I had made it and see the column G for computing turnover. It is F plus E. So F is basically premium received on sale and plus E is the difference. So going on to the next example, I had purchased a put option for SBI So I had purchased it for a 20 rupees and I had sold it for a 30 rupees. So I have a profit of 10 rupees over here, and the units are 1500 units. So 15,000 is the difference. And again, taking the premium on sale, so 30 into 1500, it computes to 45,000. So if I add difference to premium, my turnover goes on to the 60,000 rupees. Similarly, in case of Infosys, here I had purchased it for 20 rupees and I had sold it for 5 rupees. So again, here I had incurred loss. So if I multiply this 15 rupees loss per unit with the 600, here I will have a negative 9,000. But as I have already stated again and again, you have to ignore the negative sign while computing the turnover. So here I have ignored the this negative sign of difference, and I had made total of 9,000 plus 3,000 premium received. So total is 12,000 rupees. Again, similarly, in case of Bank Nifty, I had purchased it for 400, sold it for 590. So difference and adding the difference and premium received, it computes onto the 19,500. So if I take the total of column G, that is turnover, it comes to it comes to the 1,06,500 and 500. So I think we all have now clarity regarding computation of turnover in case of intraday trading, in case of futures, and in case of options. So what is the tax audit limit for Appendo transaction? Next, our question is, what is the tax audit limit? So basically, there are three types of limit. If we see the provision of section 44AB, it says 1 crore is the limit. If the turnover crosses 1 crore, you have to mandatorily get your books of account audited. But recently we had amendment to the 44AB, wherein they have stated that if a assessee has transactions of purchase, receipts or payment less than 5% of total receipt and payment, in that case, the limit of 1 crore will be extended up to 10 crore rupees. So for an example, if an assessee is only trading in the shares or only doing the business of Appendo, in that case, there is no cash transactions only. So in that case, the limit will be extended up to 10 crore. So if we have the limit of 10 crore, then in case of Appendo, we can have a limit of 10 crores. If the turnover is exceeded by 10 crore rupees, then only you'll have to get mandatorily audited your books of account. Otherwise, it depends. I'll explain the scenario when you have to get your books of account audited and when not. Coming to third aspect, that if the assessee opts for presumptive taxation under section 44AD, then the limit of 1 crore shall be extended to 2 crore. So if you want to opt for 44AD and you have to offer 6 or 8% as an income of your turnover, in that case, up to 2 crore, you don't have to get your books of account audited. But if it exceeds 2 crore rupees, in that case, you'll have to get it audited. Now, many a times the question is asked to me is, sir, what if the turnover is less than 1 crore or maybe 1 crore, but within the limit of 5%, but I have to offer the profit less than 6%, or I have to show I have incurred the loss, whether I have to get my books of account audited. So the problem here is many a time salaried employee, they are doing trading in the Appendo transactions, and many a times they incur a loss. So if I have a salary income, but I have incurred loss in Appendo transactions, whether the tax audit is applicable to me. So I would say, in case of salaried employee, this is the first time or first return wherein you are offering Appendo transactions in your return of income. In that case, no need to get your books of account audited. You just have to fill your balance sheet and P&L. You have to show that you are maintaining your books of account, and you don't need to get your books of account audited. But the tax audit becomes mandatory in the case where earlier you have offered your income, or you have offered your income under section 44AD, and now you want to opt out of the 44AD. In that case, the tax audit becomes mandatory. Even if you offer it for 3%, 2% or loss, in that case 44AD will become mandatory. But otherwise, I would suggest that there is no need to get your books of account audited, even in case of loss or profit shown as less than 6% also. whether losses from F&O transactions can be set off against other business or other heads income. So the F&O transaction, as it is a non-speculative business income, it can be set off against the other heads income, and but you have to see that it cannot be the loss or income from such, it will not be set off against the salary income under the head salary. Again, as I have already said that the unabsorbed losses can be carried forward to subsequent 8 assessment years. The loss only in case of speculative business income cannot be carried forward more than 4 years, but in other case, in general, it can be carried forward for more than 8 assessment years. So all whatever I have stated over here is my own opinion. The opinion may change in case of tax, as I have already explained. When the tax audit is applicable or when it is not applicable, it might happen that some person or some other professional may have some other opinion, but this is my own opinion. But before offering or before taking your own decision, you should study the act and then only you should take the proper decision. Whether there is a special tax rate for F&O transactions, so I would say there is no special tax rate. You have to offer it as per the normal tax rate as given in for normal business income. As for individual or HF, it is as per slab rate. For firm, 30%, and for company, 22, 25, 30, whatever is the applicable rate. So now coming to the other points and on F&O. Before going on to that, I want to give the I want to raise one question for myself only. Many times people ask me, we have computed the turnover as you have said that taking the difference and absolute total, but how to show it in ITR, how to show it in a P&L? So again, there is I have not found any provision under the income tax or act or somewhere else how to represent or how to present the turnover in case of share or F&O. But in my personal opinion, I feel that the one method can be that take all the credit or favorable differences at the credit side, that is sales side, and take all the negative differences at the debit side of the P&L, that is this purchase side of the P&L. And if any expenses are there, debit it to the P&L, and the difference shall be your actual income or loss from the F&O or shares transactions. So this can be one of the method to offer your share income or F&O income in the return of income, or represent your F&O income in the ITR or P&L. Now, other points, whether books of account and documents for F&O are required to be maintained. As I have already stated, if you are not opting for 44AD, then in that case, you will have to maintain the books of account. And there is nothing to be maintained for F&O assets because everything is ready. You get all the details from the brokers. You get the contract notes, you get the ledger accounts, you get the statement, you get the P&L of your transactions. So as such, there is nothing very difficult to maintain your books of account. But yes, if you are opting, if you are not opting for 44, and if you don't want to get your books of account, or if you want to get your books of account audited, in that case also you'll have to maintain the books of account. Can we claim expenses against F&O income? Yes, as I have already stated, in case of F&O income, you can claim all the expenses related to the business. Then again, coming to whether loss or lower income in F&O transaction requires tax audit. So in case, I have already stated that if in case where the turnover of the assessee is less than 1 crore and the assessee maintains books of account, then tax audit is not required provided the assessee has not opted for 44 in the earlier year. How to value the closing stock in case of F&O? So this is also the moot question which arises in case of traders or the persons who are doing business in F&O and intraday transaction, not intraday but delivery based transaction, who offers their income as a business income. In that case, if the closing stock is there as on 31st March, let's say for an example, I had purchased the futures of April or May in March. So if I don't square off it before 31st March, then how to value that? So as per ICDS 8, security should be valued at lower of cost or net reserve value. So whatever will be the NRV or cost, whichever is lower. So if the purchase cost is lower than the actual market value, in that case it will be valued at the actual cost. But if the market value of those shares as on 31st March or is lower than the actual cost, in that case the NRV or net realizable value as on that shall be recorded in your books of account. The difference may be claimed as an expenses in your while computing the income. So this will not be applicable in case of unlisted shares. The unlisted shares shall be recorded at the actual cost in your books of account. So next question, how to compute the turnover if the assessee has more than one business activity? This is also a very good question, always raised by many people. So let's say for an example, I am a trader, normal trader, means I have a cloth store and also I'm doing a trading in the share market or Appendo. So as the here question arises is now if I'm doing Appendo also, so Appendo business from the turnover from the Appendo is also part of the business. So how to compute the tax audit limit or how to compute the turnover limit for the tax audit? So as per the para 5 of the guidance note, they have stated if the assessee wants to offer, if assessee has 2-3 business, out of that, if he goes on for 44 AD in any one or two business, and for remaining, if the turnover of the remaining business for which he wants to maintain the books of account is if less than the prescribed limit under section 44 AB, in that case there is no need to go for an audit, because only the turnover of the businesses which for which they are maintaining books of account will be taken or taken for computing the tax audit limit. For an example, if I have a cloth store and also done the F&O transactions here, if the turnover of my cloth store is, let's say for an example, 60 lakhs rupees, and the turnover from F&O is 50 lakhs rupees. So if I aggregate both the turnover, it will go on to 1 crore 10 lakhs rupees. So it exceeds the limit of 44 AB. In that case, I may have to go get my books of account audited. But for an example, for this trading of for cloth store, if I go for 44 AD and in for F&O I want to maintain the books of account, in that case for computing the turnover limit under section 44 AP, the turnover of 44 the business for which I am going for 44 AD shall be excluded, and only the the turnover of the balance business shall be taken. So for example, 60 lakhs, the turnover of the 60 lakhs will be taken under 44 AD. So for maintaining books of account or for taking the turnover limit of 1 crore, I have only one business, F&O, and it is way below than the 1 crore, because my turnover from the F&O is only 50 lakhs rupees, which is way below 1 crore rupees. So here in this example, I don't need to go for tax audit, provided I fulfill other conditions provided in the provision of the particular section. Now I have completed the aspect of this F&O transactions. Now moving on to the taxability of dividend income. So dividend income already earlier it was not taxable in the hands of assessee. Then they had brought section provision where the dividend income over 10 lakhs is taxable. Now they have again come up with the amendment, and now dividend income is taxed in the hands of shareholders. So the question here, moot question here arises is whether the dividend income is a business income or other source income. Now it depends what is the nature of shares you are holding. If the shares which you are holding, if it is held as a stock in trade, in that case dividend income from such shares will be taxed as a business income, and in other case it will be taxed as a other source under the head tax other sources. So deduction, all the business related expenses shall be allowed in case of other sources, whereas to keep in mind that only the interest expense on borrowed money is subject to cap of 20%. So only when the income is offered as the other source income, in that case only the interest on borrowed money will be allowed as a deduction, and it is not like that a whole amount of interest will be allowed as a deduction. No, only the 20% of dividend amount is allowed as a deduction and not more than that. So there is a cap of 20% of dividend amount. So 80% of the dividend will be taxed as other sources. And if I have an interest income and if it is more than 20%, in that case, it will be capped to 20% of dividend amount. So TDS, in case of individual, if the dividend exceeds 5,000 rupees, the 10% will be the TDS rate. In case of any other SEC, there is no limit, so directly 10% will be deducted from his dividend amount. Similarly, in case of other sources, so it doesn't matter while putting the TDS. So whether it business income or other sources in the hands of shareholders, dividend rate is 10%, and the limit in case of individual is 5,000 rupees. So tax rate in both the case will be the as per normal tax slab. Coming to the tax audit reporting in some, so there are some important clauses one has to keep in mind while filling the tax audit report. So clause number 15, 16, 28, 32, those are the clauses one has to keep in mind. So we'll see one clause by clause. So clause 15, if we see particulars of capital asset converted into stock in trade, this is also very important aspect. If initially I had maintained, if I had purchased a shares and I had those shares held as an investment in my books of account, and now I want to convert those investment into a stock in trade, in that case, I have to report in my tax of audit report 3CD in clause 15, wherein I have to give the description of capital asset, date of acquisition, cost of acquisition, and amount at which asset is converted into a stock in trade. So one has to keep in mind that it is very important to report this particular details in clause 15. So one more clause is clause 16, amounts not credited to profit and loss account. Many times what happens in case of individual or a proprietor, the dividend amount received or a profit or loss from the sale of investment is directly credited to profit and capital account of the particular proprietor or a individual. Many times it is not reflected to the P&L account. So it is very, very important to report those directly report those income directly credited to capital account. Those amount or those income should be clearly reported in clause 16, like dividend income or profit or loss on sale of investment of shares. Coming to next clause, clause 28, purchase of shares of company for inadequate consideration. As I've already stated that if shares are purchased for an inadequate consideration, inadequate consideration means shares are purchased for a price less than FMV. In that case, you have to be all these details: name of the person from which the shares received, name of the person if available, name of company from which shares received, CIN of the company, number of shares received, amount of consideration paid, amount of consideration, and FMV of the shares. All these things has to be mentioned in clause 28 while filling the 3CD of a particular client. So clause 32, again, details of brought forward loss or depreciation. So it is very important from the litigation point of view also that all the details regarding the loss of unabsorbed loss, speculative and non-speculative business income shall be clearly reported here, so that if any litigation is arisen after a few years after the relevant assessment there, in that case we can prove the losses through our tax audit report. So that's it from my side in the taxation aspect of the shares and Appendo. I hope everything is clear to you, and any queries is there, so you can ask me right now, and afterwards also I am available on the given contact number and email ID also.
Thank you very much, sir. I request now the participants to raise any queries either through the chat, or they can unmute themselves and also ask directly the question. I have given the permission to the members to unmute themselves.
So there are certain questions. Can we answer right now?
Yes, sir.
So, how to determine an assessee is a trader or investor, as most salaried employees are doing trading in shares in huge volume? I think for this, the answer has been given. Okay. Next question is how to present Appendo sale purchase in the books of accounts. For this also, the answer has been given by Shubham. Right, Shubham?
Yes, yes. F&O trading can be done. And I think in last year only, I mean, in March 21, I think the permission is given by the institute to do the derivative transactions in equity, not in commodity. I think so. Chartered accountant now can do a transactions in equity derivatives, not a commodity derivatives.
Okay. For commodities, we have to take the permission.
Yes, correct.
So Appendo is for commodity and intraday is for shares. Is it correct? No. F&O can be done for shares also.
Equity also. Yes.
Equity. And F&O and intraday trading are through stock exchanges. Yes. Both can be done through stock exchange. F&O settled on same day will be treated as intraday or ordinary business. F&O will always be treated as business. It should be treated as a PGPP. The income or loss should be there, go in the PGPP. It cannot be treated as what you call speculative. The business income. Sorry. Turnover calculation is understood now, sir. But how to show sales and purchase value? We don't have. It is for shares or F&O. In case of shares,
In both the cases, we have already explained. In both the cases,
Yeah.
we have already explained.
Kindly explain by drafting a P&L with an example, sir. Okay. P&L in the P&L on the credit side, you can take all the profits in case of F&Os, and in the debit side, you have to take all the losses, and then you can take the expenses on the debit side. The net figure, if it comes as profit, you can show as F&O profit. Here, one thing, F&O turnover it is not, F&O turnover is not reflected anywhere else. Yeah. It is just F&O turnover is calculated just to check whether it comes under tax audit or not. That's it. Another, kindly explain the drafting and is there any more questions?
I request the participants now to raise any queries that if they have any in this matter. Okay, I think there is one query in the chat box where they want to know where to show stock.
Stock. In case of trading, the stocks are shown under the P&L, and in case of investment, it is shown as an investment. That's it.
The presentation will be shared with all the members
Yes.
as soon as we receive the copy from the speakers. So I think there are no more queries. We can wrap up the question and answer session. I thank both the speakers for their commentary on accounting treatment for shares bought for investment, day traders, and F&O trades. F&O transactions are to be treated as business income, and yes, books needs to be maintained. We are seeing on a daily basis number of individuals are doing F&O transactions and are not maintaining books of account. In view of the high frequency of F&O trades, they are easily covered by tax audit provisions. And with the availability of data in AIS and TIS, it becomes essential that due care is taken while computing income from F&O trades. The speakers have explained in a very easy manner how the books of account can be maintained for traders as well as investors, and also the tax implications of different kind of transactions. I thank you very much, Shubham and Wasim, for your brief commentary on the accounting treat and taxation of shares, features, and options. Thank you, sir. Thank you on
Thank you,
behalf
sir.
of
Thank you.
Vijayawada branch of SIRC. Thank you.
Thank you.
Thank
Thank you.
There is a programming announcement. Tomorrow's session is on issues, intricacies, and practical approach on GSTR 9 and 9C will be taken by CA VS Sudhir and CA Ramesh Paduri. So I request you all to reconnect tomorrow at 5 p.m. Thank you. Thank you, one and all. అదే మీటింగ్ అయిపోయింది ఎగ్జిట్ అవ్వాలి